This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast.
Welcome, everyone. Today, we're diving deep into something pretty significant, a regulatory earthquake, really, that's reshaping the European alternative funds landscape. We're talking about the updated Alternative Investment Fund Managers Directive, AIFMD 2. We'll be carefully dissecting Directive EU 224927. Our mission today really is to cut through all that legal jargon and give you the practical implications, especially if you're, say, senior legal counsel in private equity.
Exactly.
This deep dive is all about mastering this new frontier, loan origination, liquidity, specifically for Luxembourg private equity funds. It's understanding not just what the rules are, but why they matter day to day, and how you might even turn compliance into an advantage. That's absolutely right. And look, to give you a clear roadmap right from the start, let's just pull out the two most critical takeaways, the things you absolutely need to remember from this whole discussion. First, loan origination. It's now formally regulated. That means any private equity fund originating loans, and yes, that definitely includes common stuff like shareholder loans to portfolio companies, well, it's now subject to a new harmonized EU rulebook.
Okay, so not just a small change then.
Not at all. This isn't a minor tweak. It actually demands specific risk management, diversification, retention policies, stuff that just wasn't mandatory before in this way.
Got it. And the second key takeaway?
The second one is the clock. It's ticking. The key date is the 16th of April, 2026. Now, that might sound like it's ages away.
Feels like plenty of time.
It might feel like it, but the sheer complexity of these new rules, especially the transitional bits for existing funds, means you need to start your impact assessments and strategic planning, right now. It's not just advisable, it's pretty critical.
So proactive adaptation is key to staying competitive.
Absolutely. You don't want to be caught scrambling later.
Okay, so let's peel back the layers here. What's the philosophy behind AIFMD2? Let's start with the what and the why.
Right. So the formal trigger, the piece of legislation, is Directive EU 2000-24927. It was published in the official journal of the EU back on March 26, 2024. Now, to really get why it's so significant, you have to understand the legislative intent. The European Commission basically recognized that AIFs, alternative investment funds, they've become this huge source of funding for European businesses. We're talking over 250 billion euros in private credit.
Wow, that's a massive number.
It really is. So the primary goal of the directive is kind of threefold. First, create a level playing field for these funds originating loans. Fair competition, right? Second, foster a more efficient internal market across the EU. And third, at the same time, mitigate potential systemic risks. Risks that could pop up from unchecked private credit activity. It's really about balancing stability and growth.
And it seems built on some pretty solid pillars. You mentioned loan origination framework.
Yeah.
What else?
Yeah, so the key pillars are that harmonized framework for loan origination, definitely. Then enhanced rules for liquidity risk management, stricter oversight of delegation arrangements. That's a big one, especially for Luxembourg.
Always is.
Yep. More granular supervisory reporting, and even new provisions for depository services. It's quite comprehensive, covers a lot of ground.
It certainly sounds like it.
It really is. Which brings us neatly to the when, the implementation timeline. And honestly, it's not just one day. It's more like a matrix of obligations that legal counsel really need to get their heads around.
Okay, break it down for us.
So the directive itself, it officially entered into force on April 15th, 2024. That date is kind of the anchor point for all of the transitional rules. From then, EU member states, including Luxembourg, obviously, have 2 years. Until April 16th, 2026, that's the deadline to transpose the directive into their national laws.
All right, so April 16th, 2026 is when it becomes fully applicable everywhere.
Pretty much, yes. That's the key deadline for national law and full application across the Union.
That sounds like a bit of a maze, though, those dates and rules. For our listeners, is there one single date they should have circled in red? And why that one?
Well, April 16th, 2026 is definitely your firm deadline for transposition and when it all kicks in nationally. But the really tricky part, and why you need to act now, is in those transitional and grandfathering provisions for loan origination. The rules basically split funds into different buckets. It depends on their vintage, when they were set up, and whether they're still raising capital.
Okay, like how?
For example, AIFs set up before April 15th, 2024 that don't raise any more capital. They're largely grandfathered, meaning generally they don't need to worry about the new leverage caps or concentration limits.
Okay, that's good for some.
But AIFs set up before that same date that do keep raising new capital, they get a pretty generous 5-year transitional period until April 16th, 2029 to comply with certain rules. But, and this is a really critical but, if a fund is already over the new limits during this period, it hits a moratorium. It cannot increase its leverage or concentration any further.
Okay, so a standstill.
Exactly. And then finally, any new fund set up after April 15th, 2024, it's fully subject to the new regime as soon as it's transposed into national law. So yeah, while 2026 is the big date, the immediate challenge is figuring out which bucket your existing funds fall into.
Right. So given all these nuances,
Yeah.
what's the absolute first step for legal counsel right now? Sounds like waiting for the Luxembourg law isn't really an option.
No, you absolutely cannot wait. And look, it's not about rushing to redraft everything tomorrow. The most vital first step, it's conducting a really thorough portfolio-wide audit. You need to map every single fund your firm manages against these new categories. Figure out its specific compliance pathway, the strategic audit. That's the foundation for your whole compliance project. It dictates everything else.
Let's talk about the where then, the Luxembourg context. How's the Grand Duchy actually getting on with transposing this?
Well, as of today, and we're recording this on July 19th, 2025, if you look at the official Luxembourg sources, Lex, the Chambre des Députés website, there's no publicly available draft law, no projet de loi specifically for transposing Directive, EU 224927.
Is that unusual?
Not necessarily at this stage, but it means that AIFMs, the alternative investment fund managers, they have to plan based on the directive's text itself and, existing guidance from the CSSF, the Commission de Surveillance du Secteur Financier. So you're looking at things like their Circular 18698 on authorization and organization of IFMs and the detailed stuff in the CSSF's FAQs on the AIFM law.
So rely on the directive and current CSSF guidance for now.
Exactly. But the good news is, for well-run Luxembourg AIFMs, this should feel more like an evolution, not a revolution. The Grand Duchy already has a pretty robust framework, so hopefully it's building on existing practices.
Okay, let's get to the part I suspect many listeners are really leaning in for. The new rule book for loan origination. That sounds like a potential game changer for private equity, doesn't it? Let's treat this next bit as our practical guide.
It absolutely is a game changer. Okay, so first things first, we need to define the scope. When exactly is a PE fund considered a lender under these new rules? AIFMD 2 introduces 2 key definitions that really clarify this. First, loan origination. It's defined pretty broadly. Granting a loan directly or indirectly, maybe through an SPV, where the AIFM or the AIF itself was involved in structuring it, defining its characteristics. You get the idea.
So it captures typical PE financing like downstream loans to portfolio companies.
Definitely. That broad definition is designed to capture exactly those kinds of activities. Now, second, there's the definition of a loan originating AIF. This is based on a 2-pronged test. A fund qualifies if, 1, its investment strategy is mainly to originate loans, or 2, the notional value of its originated loans hits at least 50% of its net asset value, its NAV.
That 50% NAV threshold sounds important.
It's critical. Think of it as a bright line test. Once you cross that 50% NAV mark with originated loans, your fund steps into a new, more regulated category. It's something all PE funds now need to actively monitor.
Okay, so even if your fund isn't primarily about lending, if it originates just one loan, there are still some universal requirements that apply. Let's dig into those.
Yes, indeed. Even for a single loan, there's a new set of universal obligations. These need to be baked into the fund's operations and legal setup. First up, risk management policies. These are now mandatory. And it's not just box ticking. It's about having a structured approach. It reassures LPs, your investors, and helps the fund adapt to market shifts. You need to implement and annually review effective policies for granting credit, assessing risk, and monitoring the portfolio.
Makes sense. What else?
Second, risk retention, or, skin in the game. This is aimed at preventing those originate-to-distribute models where risk gets passed on too easily. An AIF now has to keep 5% of the notional value of any loan it originates and then sells on to a third party.
For how long?
Until maturity, if the loan term is up to 8 years, and for at least 8 years for longer loans. It ensures the fund keeps a vested interest in the loan's quality. Third, concentration limits. This is a key diversification rule. The notional value of loans originated to a single borrower can't exceed 20% of the AIF's capital.
Okay, avoiding putting all eggs in one basket.
Exactly. It targets the risk of relying too heavily on one big borrower. Now, crucially, this limit only applies if the borrower is a financial undertaking, another AIF, or a UCI that's an undertaking for collective investment in transferable securities.
And capital here means?
Good question. The directive defines capital as the total of capital contributions plus uncalled committed capital, net of fees and expenses. Fourth, a prohibition on connected party lending. This is pretty strict. A flat ban on an AIF lending to its own AIFM staff, its delegates, the depository, or any other entities in the AIFM's group. It's all about preventing conflicts of interest.
Seems sensible.
And finally, number 5, a ban on originate to distribute strategy. This explicitly stops AIFMs from managing funds whose sole purpose is just to originate loans to sell them off immediately. Again, curbing practices that might undermine market stability.
Okay, that covers the universal rules. Now, what if your fund is primarily a loan originator? Meets that definition we talked about. That's when the specialist requirements kick in, right? More stringent rules.
Exactly. For those funds defined as loan originating AIFs, stricter specialist rules apply. They face hard leverage caps. It's capped at 300% for closed-ended AIFs and 175% for open-ended ones. And this leverage, it has to be calculated using the commitment method, basically accounting for both drawn and undrawn commitments.
300% for closed-ended. That seems quite restrictive for some strategies, doesn't it?
It is a significant number, yes. It will directly impact how much debt the fund can take on, and that obviously affects its risk-return profile. It's a major point for strategy discussion.
One structure.
And structure, yes. The default rule is that a loan-originating AIF must be a closed-ended structure. An exception might be possible, but only if the AIFM can really convince its regulator, like the CSSF here, that the fund's liquidity risk management system is totally compatible with its strategy and an open-ended redemption policy. It's a high bar.
It sounds like it. Okay, that 300% leverage cap. It does seem tight for closed-ended funds. How much wiggle room is there really for aggressive PE strategies? And speaking of strategic tools, you mentioned something earlier, the shareholder loan carve-out. That sounds like it could be crucial for PE.
Oh, it absolutely is. It's a vital strategic tool, especially for traditional private equity funds. The directive provides this specific carve-out and exemption for shareholder loans. Basically, if an AIF's lending activity consists solely of originating these shareholder loans, and the total notional value of those loans doesn't go over 150% of the AIF's capital, then that AIF is exempt.
Exempt from what exactly?
Exempt from those demanding leverage caps we just discussed, and also exempt from needing to implement those dedicated, complex credit-granting policies and procedures.
Okay, but what counts as a shareholder loan here?
Good clarification. To qualify, the loan needs to meet a precise definition. The AIF has to hold at least 5% of the capital or voting rights in the company it's lending to. And, importantly, the loan cannot be sold off to third parties independently of the AIF's equity stake in that same company.
So the debt stays linked to the equity.
Exactly. This exemption isn't just a tick box exercise. It's a really important strategic path for legal counsel. It lets you structure financing for portfolio companies in a way that keeps operational flexibility and avoids the significant operational and cost headaches of the full loan origination roles.
Right. So with all these new rules, definitions, carve-outs, what does this actually mean for the fund documents? It sounds like we're looking at a pretty significant documentation overhaul.
We certainly are. These new legal requirements necessitate a comprehensive documentation review and update. You're translating the law into the fund's contractual reality. So the private placement memorandum, the PPM, or any offering document that needs updating. You have to include a full description of all costs and expenses linked to administering any originated loans.
Yeah.
It also needs to clearly state whether the fund might originate loans, if it could qualify as a loan originating AIF, and detail all the associated risks, policies, and limits. It's all about full transparency for your LPs.
Okay, PPM covered. What about the core legal agreement?
Right. The limited partnership agreement, the LPA, or other constitutional documents, the fund's real governing rules. These need amending to directly embed the new binding investment restrictions, things like the leverage and concentration limits. They also need to formally define the ramp-up period, which can't be longer than 24 months from first subscription, during which those limits, like concentration, must be met.
And monitoring.
Yes, it would be very prudent to include mechanics in the LPA for monitoring those key thresholds, the 50% NAV one and the 150% shareholder loan one. And finally, you'll need a new or significantly updated internal risk management policy. This is mandatory for any AIF doing loan origination, unless that shareholder loan exemption fully covers everything they do. This policy needs to detail all the processes: credit assessment, monitoring, administration, the works.
This really sounds like more than just tweaking legal docs in a back room somewhere, doesn't it? It feels like AIFMD2 fundamentally changes commercial discussions, how legal costs are structured, even project management for compliance.
You've hit the nail on the head. What's truly impactful is how this directive creates new negotiation points. It significantly shapes the general partner-limited partner dialogue. First off, the unavoidable question of costs. Who pays for AIFMD2 compliance? GPs, the fund managers, will likely argue these are necessary fund expenses, but LPs, the investors, might push back.
So LPA expense clauses become even more critical.
Absolutely. You need precise forward-looking language there. Second, for credit-focused funds, that 300% leverage cap for closed-ended AIFs. It directly impacts their strategy and leverage. It changes the risk-return profile. So you need really clear articulation and discussion during fundraising to manage investor expectations.
Makes sense. And the third point.
Third, for any fund that offers redemptions, think evergreens. Semi-liquids, a mandatory inclusion of new liquidity management tools, or LMTs, becomes a key negotiation point. The focus will be on fairness, activation triggers, all that detail.
Okay, this definitely raises the question, how should legal pricing adapt? We're clearly moving beyond simple document review here.
We absolutely are. A smart approach to this compliance challenge needs a more nuanced view of the costs. It's not just it'll cost more. We can break the costs down into two main types. First, one-off costs. These are the initial significant legal and advisory fees. Think portfolio-wide impact assessment, gap analysis, the comprehensive redrafting of the PPM, LPA, internal policies. Plus, there are operational setup costs updating internal systems to track all these new thresholds: NAV, concentration, leverage.
Okay, the upfront hit. What about ongoing?
Exactly. Second, ongoing costs. The new regime brings recurring expenses. More man-hours needed for enhanced monitoring of delegated functions, ongoing compliance checks. And don't forget the costs of gathering and reporting all that new granular data required under the revised Annex 4 reporting framework.
So, suggesting a different pricing model then.
Precisely. This cost structure really suggests that legal pricing for AIFMD2 compliance should be treated like a strategic multi-phase project, not just a one-time document update. A logical approach, maybe a fixed fee for the initial diagnostic assessment. Then, a tailored project-based fee for the documentation overhaul, reflecting the actual complexity you uncovered in Phase 1. It shows commercial awareness, valuing strategic guidance over just churning out documents.
That makes a lot of sense. So from a project management view, how should firms actually structure this compliance journey? Let's map out a phase compliance timeline.
Okay, to manage this complexity without getting overwhelmed, AIFMs really should adopt a clear, phased project plan. Phase 1. Impact assessment and gap analysis. This should be happening right now, maybe running through Q2 2026. This is your top priority. Do that portfolio-wide audit, identify every single instance of loan origination, determine which funds are loan-originating AIFs, analyze all your existing documents against the new directive's requirements. You need to know exactly where you stand.
Right, get the lay of the land first.
Then, Phase 2, policy and documentation overhaul. Let's say Q2 2026 through Q4 2026. Based on what you found in Phase 1, you draft and get approval for the new or updated risk management policies. You amend the LPA, PPM, other constitutional docs for all the affected funds.
Okay, drafting and amending. And Phase 3?
Phase 3, implementation and training. This starts Q4 2026 onwards. Here you actually roll out the new policies across the firm. You train the relevant staff they need to understand the new procedures, thresholds, monitoring duties. You update your reporting systems to capture the required data, basically embedding full compliance well before the national law actually takes effect.
Okay, that's a clear plan. Now, let's broaden out a bit. Beyond loan origination, what are the other key pillars of AIFMD2? And how can understanding the whole directive become, maybe, a unique selling point for legal pros and the funds they advise? Let's start with the new liquidity mandate, harmonizing the toolbox.
Right. So AIFMD2 introduces this harmonized list of liquidity management tools, LMTs, in a new Annex V to the directive. The key requirement here is for open-ended AIFs. They now must select at least 2 appropriate LMTs from a specific list.
What kind of tools are on the list?
Things like redemption gates, fees, extended notice periods, and they have to embed these chosen tools directly into their constitutional documents. Importantly, just having swing pricing or dual pricing isn't enough on its own to meet this 2-tool requirement.
And ESMA is involved here too.
Yes, the European Securities and Markets Authority, ESMA, is developing detailed regulatory technical standards, RTS, to specify exactly how these tools should work. They've already put out draft RTS and guidelines for consultation.
And this is relevant even for PE.
Well, most traditional PEs is closed-ended, so maybe not directly. But it's highly relevant for that growing world of evergreen funds, semi-liquid strategies, continuation vehicles, anything with redemption features. It's a big development for them.
Definitely an area to watch. Okay, next up. Delegation and substance under the microscope. What's changing there? That's always a hot topic in Luxembourg.
It certainly is. The directive really reinforces that old principle. An AIFM cannot just be a shell company, a letterbox entity. It formally codifies a key substance requirement that, frankly, the CSSF already expected based on practice, which is that the AIFM's business must be effectively run by at least 2 actual people, employed full-time or executive members of the governing body, and they need to be domiciled in the EU.
So that part isn't entirely new.
The principle isn't new for Luxembourg practitioners, but codifying it EU-wide is significant. The main change, though, is the enhanced reporting on delegation. AIFMs will now have to give much more granular detail to the CSSF about all their delegation arrangements.
Like what sort of detail?
Who the delegate is, where they're located, exactly what activities are delegated, and critically, what human and technical resources the AIFM itself has in place to effectively monitor that delegate. It's really about ensuring genuine oversight and accountability.
Okay, so if we pull all these threads together, loan origination, liquidity, delegation, reporting. What does this mean for competitive advantage? For a legal professional in this space, it sounds like really mastering this directive could be a major differentiator.
It absolutely can be. And that brings us to the ultimate unique selling point, or USP, for legal professionals here. The real value isn't just knowing the rules of AIFMD2. Lots of people will learn the rules. It's the ability to translate these complex regulations into strategic, commercial, client-friendly advice.
How does that look in practice?
Well, it's demonstrated in several ways. For instance, by showing a PE client how to strategically use that shareholder loan exemption to keep operational flexibility, turning a regulatory hurdle into a demonstration of smart fund management. It's also shown by proposing that phased, value-based compliance project and pricing model we talked about. That shows commercial thinking, not just reactive legal work.
Right, proactive and strategic.
Exactly. Furthermore, it involves framing the proactive adoption of these rules and clear communication about it with investors, not as some painful burden, but as a sign of best-in-class governance, something that can actually attract more sophisticated LPs. And finally, it's about being able to articulate the bigger picture, that this regulation, yes, it's challenging, but ultimately it strengthens the Luxembourg AIF brand. It ensures a robust, harmonized, transparent framework for the future. That's a powerful message.
Okay, let's quickly circle back then and revisit our 2 essential takeaways, now hopefully reinforced by everything we've discussed. The 2 things we really want you, our listeners, to walk away with.
Right. First, loan origination is now a regulated activity for all private equity funds engaging in it. You absolutely must know the rules, especially that strategic shareholder loan exemption, and you need to make sure your fund documentation is updated to reflect reality.
And the second?
Second, that deadline, April 16th, 2026, means you need immediate strategic action. That comprehensive portfolio-wide audit, it's the mandatory first step. You need it to successfully navigate the complex transitional rules and deliver a successful compliance project on time.
This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.